Welcome to the FirstBank Fintech podcast, where we bring you the latest challenges, opportunities, and trends in the fintech world. I'm your host, Talila Doherty Aditono, and I'm joined by, I call him the man with a melodious voice, my esteemed co-host, Mazzino Appeal. Mazzino, how are you today?
I am fine, but then I'll start by saying, stop it, I like it, because I love it when you do that. It's just so nice. Gives me that, let's go.
Love it. Thank you so much. So today we are discussing a fascinating topic, which is the importance of partnerships between governments, NGOs, traditional financial institutions, and fintechs in the role of providing access to financial products to the unbanked and the underbanked. Globally, over 1.4 billion people are still unbanked and many are underbanked. And while this is a big challenge, we must remember that these key stakeholders that I just mentioned are key to solving these issues and providing opportunities and value to the unbanked. Our guest for today is Mr. Emmanuel Daniel. He is the founder of Tab Global. So nice to have you with us, sir.
Great to be here, Talula.
Wonderful. Could you tell us a little bit more about yourself and about Tab Global, please?
Well, I'm the founder of something originally called The Asian Banker back in 1996, where I connected the banking industry of at least about 18 Asian countries. And then we grew into Africa, into the Middle East. We grew into Dubai and so on. And then we became Tab Global. So basically, in the banking and financial services industry, we rank banks, we rate them, we write reports on them. And now we work with specific banks in their overall long-term strategy. So it's been really fun. We do a whole range of things in the banking industry. But then when you cover something like banking, you then also get to meet and interact with decision makers at governmental levels, so ministers of finance, central bank governors, and so on. And so now I've been moving more into geopolitics, looking at how countries trade with each other, affect each other. And today we are moving very much into a multilateral kind of a global ecosystem. So there's something there as well.
Oh, fantastic. Well, thank you so much for illuminating on your very impressive background. You're certainly the person that we need to be speaking to about today's topic. So let's dive straight in. So how important do you think it is to have partnerships between the key stakeholders, from the government to the NGOs to the traditional finance institutions to the fintechs, in order to provide access to these financial services for the unbanked and the underbanked?
So the first thing I'd like to point out about this whole idea of financial inclusion is that it's a phrase that was invented by the platform players. So if you go back to the early 1990s, the rise of Yahoo and then Amazon and then eventually Google and Facebook and so on, these are the platform players. And their goal in building platform and the way in which it's funded is to onboard as many customers and users as possible and onboard them at whatever cost it takes, because the venture capital players are funding them. And then after you've got critical mass and after you're the dominant winner takes it all player, then you start to monetize those relationships. These were the players that were looking around the world for yet another theme to build on, and financial services was a theme. And so they introduced this idea called financial inclusion. So financial inclusion, and I'm probably the only person in the world who says this, that financial inclusion as it was invented by the platform players is a lie. Because the whole idea is to onboard millions of poor people and then monetize them, make them spend money, make them indebted, and so on. Okay. Now, I'm not saying that financial inclusion as a concept is not valid. First, we need to know where it came from and then contextualize it and then work it to achieve what it's supposed to achieve. Now, the whole idea is that if you're able to reach out to the lowest levels of community, which banks are not able to do today because banking itself is an expensive proposition. In order to manage your bank account with any bank costs the bank money. So they try to either make you pay for that service, or you have to have a certain entry level. So then how do you start to include services for people who are below the poverty line or at subsistence level? What you want to do is to give them access to credit and so on. Now let me just say this, that it is not necessary for anyone to have a bank account. A bank account is not a passport to wealth or to getting out of poverty.
Sorry, can I just ask you something regarding what you said, which I find really, really fascinating. You said it's not necessary for everyone to have a bank account. Surely, when you have a bank account, you have access to, like you said, credit, and there's other tangible benefits that come with having a bank account. So why don't you think it's so necessary?
So today, with a lot of technology already in place and a variety of different players, banks are not the only providers of credit.
Right.
Banks are not the only providers of access to finance that people at the subsistence level can improve their well-being and all of that. So it's not the bank account. What we need to focus on is what is it that we're trying to achieve at the end. Meaning is that you look at where the end user is and work backwards into thinking what the logical formula that is required to get them there. So one of the things I do to measure this whole idea of financial inclusion is whether, for example, the cost of credit comes down because of putting poor people on affordable platforms. And the answer, unfortunately, and my organization actually does research on this around the world, is that the cost of credit has not come down yet. And a lot of the venture capital funded platforms, the whole idea is that you're just waiting for the moment where they are able to monetize these relationships. So in the old days, if you look at financial inclusion where technology wasn't involved, in areas like the social credit companies and so on, their cost of credit is very high. It's about 28 to 30% per annum. But when the platform players started to promote this concept of financial inclusion, the cost of credit didn't come down. It's still 28 to 30%.
So it's quite expensive.
So what fintech players need to figure out is how to make finance available and that the end user actually benefits from lower costs. And there's a lot of work to be done on that front, on the technology front. The way in which you create identities so that these users can be onboarded, the way in which you assess their credit worthiness, the way in which you track their transactions. All of these involves technologies that can make finance affordable to these people. So this is where that partnership thing that you're talking about starts.
Now, Tallulah, there's something very interesting that he said from before, Emmanuel. You talked about your experience in Asia, and that kind of like brought you to look at the relationships that you have in Africa. And I'm wondering what the similarities are between Asia, the Asian market, and the African market. What the challenges are, especially for the African market, because our unbanked people aren't just there out on the streets, they're in the hinterlands, they're all the way in the villages. So I'm wondering how they're included as well, since we're also talking about inclusion. So difficulties, challenges, and also the similarities between Asia and Africa.
Very interesting, because I'm Asian. I work out of Singapore and Beijing, and then come out west towards Dubai, and then the rest of Africa, and with a Western education. And I'm in the US and the UK several times.
You're a
year.
Global person.
In that way. So I have that perspective. One of the interesting things that I've deciphered is that we have so much to learn from each other, Asia and Africa. There are areas in which Africa has taken a lead. When you think about what's happening on the mobile phone, and being able to use the mobile phone as a bank account, for example, Africa has gone ahead on that front. It's working selectively in countries where access to bank accounts are not very strong, not very well in countries with a strong banking system. Now in Asia, we have large countries, just like Nigeria. Indonesia is 280 million people, and Bangladesh and India and China, for example. So the speed with which China especially has embraced technology and taken credit to the masses. You have players like Ant Financial, for example, which can give credit to distributors of manufactured products, for example. So if you're a milk distributor, and this is a real case, of a milk manufacturer for the last 20 years, Ant Financial works with the principal to give credit to, the few thousand, I think it's like 20,000 distributors down the distribution line. And that credit is administered in seconds, with credit profiling and insurance added to that. So those technologies can have worked very well in specific areas in Asia and can be exported to Africa, and for Africans to learn and to get onto it. The one interesting thing I discovered about Africa, relative to Asia, is that technically, Africa is actually underpopulated. You might not think this when you're living in Nigeria, but as a continent, you're actually more sparsely populated than in Asia. And why that is important is that
that's the first time I've ever heard that. I'm thinking of challenging that, but it's okay because this is
no,
very
but
interesting.
I've heard that Namibia in particular is quite underpopulated.
It's very empty. That I know. It was one of the few countries in Africa that I can tell you that happens. But Nigeria.
Yeah, Nigeria is a special case.
We are special. Okay, so let's take us out of that equation then, I guess.
But why I bring that up is because the reason for the economic success of Asia, you take countries like Korea and China now, right? But also Indonesia and so on, is that we are sufficiently populated to create real economies, to generate wealth from the critical mass that we have. Many African countries don't have that advantage yet. But Africa is growing dramatically, much faster than Asia. Many of the cities do have a critical mass of population, although entire countries might not be. And so the craft by which you create real economies will be different for Africa relative to Asia. But when you get there, some of the infrastructure you require are the same ones that we've developed in Asia. In fact, the Nigerian Central Bank works very closely with the central banks of Malaysia and Singapore, more than it does the central bank of the UK or the US, because there's so much to learn from each other. And in fact, Malaysia, for example, has an Islamic banking, infrastructure, and that's more relevant to Nigeria than to some other countries. So there are many similarities. In some ways, we've gone ahead because of our economic profile, and in some ways, you stand a chance to start from an empty sheet. So in payments, for example, the reason cross-border payments are working very well in Africa is because you're starting with less regulation, a lot more opportunity, and critical mass of populations that interact with each other across borders. So there's a lot happening on that
right
front
mix.
here.
That's certainly very fascinating. And I wanted to touch on something you mentioned earlier, which is to do with mobile money and, how that is helping people in rural areas, to become banked because they're just using their mobile phone. So how important do you think digital financial platforms, fintech startups and mobile money is in terms of driving this wave of financial inclusion?
In fact, that part of the story is a done deal. There are many mobile money players in Africa. Many of them are even valued at incredible valuations, although I would say that those valuations are a little bit fluffy because you need to bring them to market and in order to be able to realize those valuations. But the basic principle that number one, the payments ecosystem, the payments infrastructure is now domestic, not something that is imported from Visa or MasterCard. Asia is too hardwired with Visa and MasterCard, so that every time we do a transaction in Asia, we're actually rewarding a company that's listed on the New York Stock Exchange. Whereas many of the African cross-border payment players, they brought the profit back to Africa. So that's an incredible achievement. But what now needs to be done is to complete the value cycle of a payment initiative, or say, for example, remittance. In a country like Philippines, for example, the banks have figured out how to create assets out of the remittances coming in back from Filipinos working abroad. And Philippines is one of those countries which has millions of its population around the world. And so the remittance industry is very important. I think it's at about $30 billion or something a year, one of the highest in the world. Now, bringing remittances back is only part of the story. Creating assets from that is the second leg of the story. And that's something that the Philippine banks have done very well. They enable their expatriate population or their, the diaspora outside of the Philippines to create assets like buy property in the home country. They've started to recognize, the assets or the incomes being generated wherever they are in the world. So banks and fintechs, the formula is now more or less in place in that a lot of the fintechs do the originations of the relationships, and the banks are needed to complete the relationship itself. What banks have that many fintechs don't have is the balance sheet of the business. And that's something that in technology or in fintech communities they fail to realize is that banking is still a balance sheet business. The institution that has the cheapest access to cost of funds is much more powerful than an institution that has a lot of technology on the front end. So, and we've been learning this again and again, okay, in areas like buy now, pay later, for example, BNPL, and all of that. The ones that succeed are those with the balance sheet. The ones that fail are those with the technology, but not the balance sheet. And that sort of thing. So that's where the relationship starts.
You talked about completing the value cycle here. So I'm very, very curious as to, in trying to complete that value cycle, how do you measure success? How is it measured in Asia? How could it be measured, or how is it being measured in Africa here? Is it in, like you said, when it comes to remittance, or when this turns to assets? What exactly indicates
that
success?
You're able to buy a house and the house value goes up over a 5-year period, and the house is in the village. So when you start seeing that property prices in your villages start to rise because of the remittances that are coming back into the country, and you want to know another measurement?
Yeah.
That your kids are becoming fat. Okay? Because, mom and dad are working somewhere else in the world.
They're very all right. They're getting all the money in.
And that's a problem that the Philippines is facing right now.
Interesting. Obese kids.
Obesity, right, in the villages, because they are comfortable. They have got very good social structures. They've got homes that they own. And in fact, my own employees in the Philippines, they send me photographs of their houses.
And the pudgy kids too.
and their pudgy kids. But that's a social way to look at it. But it eventually shows up in the GDP of the country. Tomorrow at the conference, I'll be sharing the story of Bangladesh, which was supposed to be in 1971. Henry Kissinger called it a basket case, irrecoverable as an economy. But because of the way in which finance was extended to women in the villages and so on, over a period of time, the per capita GDP of Bangladesh today is higher than that of India. And the Indians are jealous. So
now that we're talking about different countries, I want to include Nigeria here specifically because I'm wondering what the diasporans are doing, the Nigerians living outside of Nigeria, and how that is yet to really take note. We're yet to really take note of their contributions to Nigeria. Why aren't we taking advantages of these partnerships that we have from outside the country with Nigerians that are living outside?
When I came back on this trip, I was really sad to see that a country that was very promising just 10 years ago hasn't made enough inroads into building a real economy. In fact, 10 years ago when I went to South Africa, the South Africans said, go to Nigeria, that's the future, right? And now you've fallen down the ranks below Egypt, and below a couple of other countries. Now, that has to be built, and there is a role for the financial sector to be part of that infrastructure, to create domestic wealth, and that from there, the domestic industries and so on. It can be done. It is being done in, developing countries. So you take a country like Philippines, which is 100 million people. These are mid-sized countries. When I travel around the world, I look out for these mid-sized countries, and Nigeria is definitely one of them. And you've got enough examples of mid-sized countries around the world. Brazil is the other one Nigerians can learn from.
Fantastic. And I want to talk a bit more about the challenges specifically in Nigeria and in Africa in terms of trying to drive financial inclusion. I know of quite a few fintechs in this space who specialize in sort of agent banking, where they get their agents to go around and try to, onboard, whether it's market women or just other, unbanked communities. What challenges have you seen, and what solutions do you think can be preferred, especially from your experience in Asia and other parts of the world?
One of the reasons why in Nigeria and a lot of Africa, the financial solutions are being deployed by telcos rather than banks is because banks are way too comfortable with their traditional business. When you want to do trade, the bankers will ask, what is the documentation that you can provide? Can I provide credit against that documentation and so on? But trade today is on a cash payment basis in a lot of places. So banks need to go to where the action is and see how people who are in the trading community are making their everyday living, and then try to figure out how to be part of that community. People in the trading world, in fact, at the airport coming in, I was just simply surprised the number of Chinese traders were coming into Nigeria. In other words, there is money to be made in Nigeria, right? And they have their own, credit facilities, their own relationships with financial institutions to make them successful. And Nigeria has to empower your own trading community to have access to that credit in order to be able to participate in global trade. I'm
really sort of fascinated by what you said about, the traditional banks or the bigger financial institutions are just simply too comfortable and they don't really need to go after the unbanked. But there are fintechs that are stepping into the space to address this issue. But how do you think they can be supported by the government, by the NGOs? What can be done to support these fintechs who actually do want to do the legwork of going after these underserved communities?
One of the beauty of banking is that a bank is successful only when it's rooted in its local community. And this I've seen everywhere in the world. And I read balance sheets of banks and I look at the key numbers, and the numbers tell me how deep they are and how close they are with their local community. And one of the most important part of that relationship is the deposit relationship. If a bank can go out into the local community and persuade the local community to save your basic transaction account with the bank, you've already started the relationship. Because just through that account, a bank understands what your daily needs are, what your flows are, and what your profile is as a employee, as a business person, whatever it is. And it's also the cheapest form of funding for a financial institution. So banks need to get that right. And when they do that, they become embedded in their local community. A lot of the solutions lie exactly there. That means that you look at the balance sheet of your own customers. That's where the story is. And then of course you bring in the NGO layer, you bring in the fintech layer to facilitate the relationship, to let it flow a lot more smoothly. And today we have a lot of technology around that.
I like to think that banks actually are capable of doing much more than they're doing here in Nigeria. I think that by a large extent, why they feel restricted is because of the policies that are in place, also the regulatory bodies that are in place. You can't do this as a bank, you can't do that as a bank, you can't venture into insurance. It has to be very separate, and your duties have to be delineated so that we know you're a bank. But what would be the ideal bank for Africa? What would be the ideal bank for Nigeria? Would it be one that has the banking infrastructure and also has the mobile apparatus? Because seen as mobile is much more embedded in the people. Everybody's got a mobile phone, thus you can bank. The fintechs have made it easy for us to bank because, hey, they're the bridge between the people and the banks. But what would the ideal bank be?
Ooh, this is a very tough question because banks...
I'm sorry, I asked tough questions.
Yeah, because banks are complex institutions. They're given a license for a very important reason, because they're part of deploying the economic policies of the government. So the interest rate, margins that the bank has is directly related to the exchange rate of the country, and the cost of credit that the government wants to deploy into the economy and the exchange rate of the currency and so on. So, and then that's at one level. And then another level, banks work very closely with the capital markets. And the capital markets in a lot of African countries are broken right now, because not many companies can go to a stock market and raise capital. The IPO market is broken. And when the IPO market is broken, the only source of credit or capital is actually credit that the banks can give. And that's very expensive as well. So banks have a multifaceted relationship with the economy and the wealth of individual people. So that's why it's a very difficult question to answer. And that's also why it's important to have different types of institutions focused on different types of the different facets of an economy. So you do need retail banks that have mastered the art of going down to the cheapest customer and extending banking facilities to them. You also need corporate banks and you need wholesale banks that deal with the capital markets. My first port of call for answering your question is a bank has to firstly decide which aspect or which facet of the economy they want to play in. So a bank that is domestic to a rural community in one of the regions has a different role from a bank that is national or a bank that is in the capital city. Even between banks, there are different layers of credit costs. The smaller banks actually borrow money from the larger banks, and that affects the kind of customers that they can get because the cost of credit to that community will be much higher than a bank that is national, for example. To some extent, banking can be entrepreneurial in that an entrepreneur has to decide which segment of the community he's serving and then work out his funding costs and then go out and ace that community. So if you are serving the poorest population in a remote province, your cost of credit will not be low. It'll be very high. Then you have to figure out all the mechanisms you need to put in place to make that successful.
The mechanisms lead to the partnerships that you have to make to be able to make each one work for the other one. Interesting.
So I'm really interested in what you've just mentioned regarding the cost, and there is a cost to banking. And with these underserved communities, often they're poorer communities. So what can be done to sort of assist them in, because even if it's the smallest charge, there is still a charge per transaction. What can be done to facilitate the unbanked coming onto these banking platforms and being able to afford, to be on these fintech platforms?
Where banks are today is that they are stuck with huge amounts of investments in core banking technologies with a general ledger and batch processing, which slows them down dramatically and adds to the cost. And then at the other extreme, you have new technologies that have completely solved the problem already, right? So banks need to be on that journey to try and reduce the cost of their own back-end technology, and they do that also by working with fintechs that have helped them to solve different aspects of it. So there's the origination aspect, there's the middleware layer, and then there's the back office, right? So each of these layers require investments and relationships with fintechs, and not just with fintechs. There's this whole area called APIs, or application programmable interfaces, right? And APIs means that any of the user of banking services can design their own interfaces to interact with the banks. And that technology also exists today. So, banks need to enable their customers to decide how they want to interact with the bank. And for that, bankers need to have a different mindset. They need to understand where technology itself is evolving. And then they need to build their own roadmap to becoming better run institutions.
Really, really well said. Well, thank you so much, Mr. Emmanuel Daniel, for really educating us and giving us a global perspective on financial inclusion and how partnerships can help to enable that.
Let's also let them know that he also has a knack for comedy. He also wants to be a stand-up comedy. If this doesn't work,
stand-up failure.
There's always a backup plan.
Yeah, I got to work on that one.
your punchline.
Thank you so much. We really appreciate having you on. It's been such an insightful conversation. I'm your host, Talula Doherty Adejono, joined by Mizzino Appeal, of course. Until next time, we'll see you on the Fintech podcast, powered by First Bank Nigeria. Thank you.